How you doing, good people? My name is Larry Jones. So, stock picker Larry Williams says that he's spotted a bottom, and he sees nothing but a green market from now until the end of the year. So, of course, you should be buying. Then, Jamie Dimon, CEO of JPMorgan, and other bankers are saying, brace yourself. The worst is coming. We're going to crash and burn. So who should you listen to in this turbulent market? You know, it's all over the place. Hey, for those of you that don't know, my name is Larry Jones. Go ahead and hit the like, subscribe, and notification bell. For those of you that's been rolling with the family, hey, go ahead and hit that like button. But make sure you got that notification bell checked. Hey, if you see any comments in the comments section, don't fall for spam, all right? And anything I say is not a suggestion for you to buy, hold, or sell. We're just trying to make sense of it all. And so, you know, from day to day, I'll post what these guys say, all right? You can't take it away from Larry Williams. The guy is brilliant, and he's called it before. He's called it in markets like this before. He has way more tools and way more money than I do. And so we have to listen to these experts, right? And then Jamie Dimon, I mean, he's over JPMorgan, right? Needed I say more? He's literally the bank. And so he can look at how people are saving money and spending money. He has way more data than any of us YouTubers. So who do you trust in this market, right? So one week, one day, it's buy, buy, buy. And the next day, it's sell, sell, sell. And so what you have to do is develop a plan that's going to be consistent for a volatile market. Here we go with the drunk uncle again. For those of you that don't know, we are dealing with the drunk uncle at the picnic. He's coming, and this is what the market is. He cool. Then he's hitting the little liquor that he has in his flask under the table. Now he's laughing. And then 5 minutes later, he's cursing everybody out at the table. And then 5 minutes after that, he's crying and apologizing and saying, I love you, I'm sorry. This is what the market is doing. It is having a total meltdown. So all we could do is plan accordingly. I want to give you some key things to look at, right? This one is going to be different. It's just the overall market. China right now, right? China's supply chain situation, the supply chain situation as far as imports from China should be getting better because places like Beijing or Shanghai is now opening up to, you know, not fully, but, you know, they had the zero tolerance as far as COVID, and now they're opening up, which should be easing up some of the supply chains that we have. We get a lot of stuff from China, good people. And if you don't believe it, just open up the hood of your car. Look at the furniture you're sleeping on. This is a world market. And so a lot of the supply chains, even our chips, are from Taiwan. The chips in everything, your refrigerator, your cars, you name it, we get our chips from there. And so you can't just say, hey, look at America, right? And so if our supply chain is going to be easing, that's going to be good for the economy. We do know we got the geopolitical stuff going on. We don't know what Putin is doing. We don't know what he's going to do from day to day. Let's just call it what it is. By the way, Facebook ticker symbol in about a week, June 9th, will be changing from Facebook, FB, to Meta, META. So if you have Facebook, look in your portfolio, you will no longer see FB, but you will see META. That is Meta, same company, ticker symbol change. That's it. Right. We also see signs that the economy is slowing. The economy is slowing down. Now, it hasn't stopped, but it's slowing, right? We got a slowing economy, but we also have a slowing inflation, which is good, right? We don't want the economy to slow down. We want inflation to slow down. So we need the economy to speed up, GDP to get more, grow more, and we need inflation to come down. So the Feds, you know, depending on what day of the week it is and what Fed you're talking about, you have a lot of hawkish talk from the Fed, right? And so that is also weighing on the market because the market simply wants to know, what are you going to do, right? Not going from hawkish to, dovish, and then from dovish to hawkish. Just all of the feds, not the state by state feds, need to get together and resound one united message. That would be good for the market and I believe the economy, right? The cost of buying a house is near an all-time high. All-time high. And then last, we have automotive industry has changed its tune. Let's look at a few things and then I'm going to end it right here. And I'm going to, again, reiterate what I am doing with my stocks and my portfolio. Remember, this does not reflect what you should do, but I'm just going to paint our overall picture so we could kind of see what's going on. So as we know today, if we look here, we can see that the Dow pretty much is back where it was in the last 5 days. I believe this was Friday. So from last Friday, all of the down, and we have a green day and we like, yay, but we're saying yay right here, but we were here just on Friday. And now here we are a few days later. Then we back up, back down. It's all these mood swings. So the reality of it is from Friday till today, which is Thursday, we're just pretty much made back up. When in doubt, zoom out, right? But we had a good day today. The Dow, look at that. 2.27%. That is great. I'm sorry, that's for 5 days. Let's go to the 1 day. Here we go. Today, up 435 points, 1.3%. Let's add the NASDAQ there. Look at that. That looks good. Let's add the S&P. Look at that. All green, all came roaring back. They were red this morning at opening bell. And so you can't even look at the pre-markets now. You can't even look at opening bell. And charts are just kind of out, and fundamentals are just kind of, so you really don't know from day to day or from hour to hour what the stock market is going to do right now. There's an end goal to all of this. Just hang with me. So now, here we go. Market loss for cars. Look at this. All of these cars, Ford, Toyota, Honda, Hyundai, Kia, Subaru, all have declines and choked because of the supply chain, right? Where are we getting these supplies from? Just like I just told you, from, China and all of these other places that are big on manufacturing. So therein lies the problem. So this should get better, right? We hope, right? So let's look at that. Let's look at this. So in America, the automobile industry is slowing down, but in China, it's expected to pick up after a policy shift, right? So this was the first of this month, June 1st, right, when this came out. But look at this. So in a list of 50 new measures to stoke the economy as it emerges from the lockdowns, all right? The government focuses on programs greater consumption primarily amongst these promotions were increased quotes for passenger cars license plates and reductions in taxes for passenger car purchases, right? The reduction adds to increased focus on bringing EVs to a broader population. So we already know that you guys know I'm big on EVs for the future. And I know you gas lovers say, hey, it's too much, too quick. Well, whether one day somebody pulled up in a Model T Ford and he was right next to a guy on a horse and carriage, right? The guy on the horse and carriage say, what's that? Yeah, but you got to put gas in that thing. I get it, good people. I get it. But it's coming. Just like the car was coming and you got off the horse and you got into the car, EVs are coming whether you like it or not. Eventually, you live long enough, you won't even be able to buy a gas car. So for those of you that are long-term traders, I am bullish on electric vehicles and charging stations. You guys know that roll with me, all right? And so these are some of the things I want to look at because these are signs to come, right? So I was in Valparaiso today. This is how you know, good people. I want to give you some secrets on what to look for. When you start to see automotive, let's say automobile sales, a Ford dealer or whatever, and you start to see these signs, all credit welcome. It doesn't say all credit. Some will say all credit accepted. They don't mean that you're going to get approved, because it's hard to get it approved now with higher interest rates. But all credit accepted or all credit welcome, that means they're hurting right now. That means that their sales have what? Slowed down. These are signs, right? These are also signs that a recession is coming, right? That the automobile industry is catching it. And what else is catching it? Housing, right? So here we go. The wild housing market is scaring young people away from buying a house, survey says. And here's why. As a new survey by Monday morning, consulted decision intelligence company found that 48% of Gen Zs, those that were born between 1997, 2012, and 44% of millennials born between 81 and 96 say they are less likely to buy a home given the state of the housing market over the last 2 years. The compared to 30% of baby boomers, it's your mama and your daddy, and 38% of people overall. And so what's happening is they're going, this is insane. It's just too much money. So why are you bringing that up also, Larry? Because the housing market, automobile sales, and job loss. Let's cover job loss. You got 6.5 billion unfilled jobs. What changes that really quick is, it's not that those jobs get filled. The companies that post those jobs take those jobs down. Everybody in big tech is laying off now, including Amazon. Remember, Amazon was hiring tens of thousands of people. Now they're laying them off because they overhired, right? And they weren't set up for the reality of this volatile market. So, having said all of that, remember everything I said. I want you to go and Google it. What do you do in this market? Well, I'm telling you that I've been consistently saying that I don't see inflation starting to peak until around Q3, which is about it. We're seeing signs of slowdown, but not peak. So you got the slowdown, you got peak, and then you got decline. And so I believe actually that Q4 will be a decent quarter for the stock market. But that's just in this time frame with a recession looming. So I'm not all about gloom and doom. I'm about preparation. We always say here at Stock Up, we not scared, we prepared. So I'm staying 70% cash, but I'm still have 30% in the market. We're going to make money back. I was showing you guys what happened to Mullen over the last couple of days. For those of you that didn't see the last two videos, I wasn't saying buy Mullen. I was really giving you information for those of you that already had Mullen, which it is a little down today, but you made some of your money back. And so that's what I've been focusing more on now. For those of you that did not panic sell, you made your money back by holding. All right. And so that's what I'm doing. So I'm going to continue to buy some of these dips where I see. I'm going to limit my margins, meaning I'm not trying to make 50, 100%. I'm going to be happy making 15%. I'm going to be happy making 25%, right? 20 to 25%, which is the benchmark. And then we're going to be taking profits in some of these plays. But as you guys know, here recently, we just kind of been sitting still and not buying nothing. But we've been dollar cost averaging in our portfolios. What portfolio? The Larry Jones portfolios. I got three. You guys know I got a ETF, I got a growth, and I got a blue chip. And what I suggest for you to do is to continue to cash up. I'm at 70%. I'm suggesting your cash up should be more than you have in the market during this volatile market. And yes, you can buy some of the dips and sell some of the rips, but you better be a good stock picker to do that, because the amount of time that you hold stock in this market is short. It's short-lived. It's not like it was in 2020 and 2021. This is the new reality. But we can make money and we can be prepared for what's to come. And analysts still think, I don't have a crystal ball, that a recession is coming next year. We don't know. In about 2.5 months, we will find out emphatically if we're in a recession already, because by the time we find out we're in a recession, it is 6 to 7 months already in the recession. We will find that out when we get Q2 numbers, gross domestic product. All right, good people? Hopefully some of this helped you. But what I would say is, I know a lot of you guys have a lot of portfolios and brokers, and you got a lot of red in your Robin Hoods and your Weebles. And so I'm just going to tell you guys that continue to manage those portfolios, but also get a new portfolio. And the new portfolio that I'm suggesting that you get is Moo. And the reason why I'm suggesting that you get the Moo portfolio is I only want you to put cash in that portfolio and do nothing else with it but cash, cash, cash. Because right now we are cashing up and we are getting ready for the true dip. All right. So look at this. You guys see this free share of Lucid? The good people at Moo allowed me, your boy, your humble servant Larry, to pick a stock to give you guys. And I picked Lucid because it's free. You won't lose anything if it goes down. And you only have to deposit $100 into Moo. For those of you that download the link, get it funded, because you have a time you have to claim your stock, right? And then, of course, we have Weeble. And Weeble's promotion is deposit 1 penny and you're going to get up to $12,600 worth of free stock, a minimum of $36. All right? I'm going to leave it right there. Leave me a comment of where you think this market is going or headed. Do you think that it's all clear? Do you think that this will end by summer? Or do you think that we're just going to have green days, red days, and then Q4 will be better? All right. And I'll be looking forward to reading them. Right. We love you guys. Live, love, laugh, and learn.